Hi everyone, welcome to today's video. So on this video, I'm going to help you understand why I am building a $1 million portfolio in the US. I'm investing more money in India also. So I'm a net buyer in the market now, right? Why am I doing it? Because a natural question comes that, you know what, I've been reading articles that Mr. Warren Buffett is sitting on 50% cash on its portfolio. So he's probably trying to time the market. That's a very bad strategy. Don't do that. I'll explain why it can't be done. Okay. But naturally, if such a big investor, such a powerful investor is saving 50%, 60% of his portfolio in cash, natural question comes that, boss, you know what, the market is about to fall. If I invest in the market right now, I will lose money. So is that something, or is that explanation that you should believe more in, or you should move to point B? Or second option is what you should be worried about. The second option is that, see, if you miss the 10 best gaining days in the last 10 years in the market, your return will get halved. How does the mathematics works? You can take a look at this entire calculation. It will convince you. The broad line here is, and I'll quickly go through it. So the broad aspects here are that, see, $10,000 investment, you do it with INR also, play around with Indian index. Again, the same mathematics will play out. So $10,000 investment at a average CAGR of 9.8, that is what S&P 500 or the US index has given in the last 10 years. Your total portfolio will become 25,470. But if you miss the 10 best gaining days in the market, it will drop to 17,244. And the average CAGR will fall from 9.8% to 5.6. So roughly your returns become half. Now this is a very big finding, because if on the one hand you are believing in the theory that, hey, let me time the market like the way Mr. Warren Buffett is going to do, there is a very good chance now that you might miss the gain. So what should you do? Should you invest in the market right now? Should you just wait and watch? Yeah, so that's the entire confusion that I'll try to solve for you. This is not a personalized advice. I'm just trying to explain you what I'm doing. Why am I doing? So in case you're a serious investor, do watch this video completely. Only then my strategy would kind of make sense for you, right? So let me explain this entire story in 7-8 key points. Number one point why I'm investing in the market is that the markets have substantially corrected. For example, if you take a look at NASDAQ, the NASDAQ itself has corrected by roughly 12%. Roughly it went down to 13.5% correction. This ETF is trading at roughly 12% correction. Now, this is a fairly okay correction to begin with. Now, should you invest all the money that you have right now? No, that's not the point. But the point is that at this stage, position building should be started. This is one. Now, what about India's market? So if we take a look at Nifty 50 index, what you will notice is that India's market actually corrected by 16.5%. And in the last, because we are looking at a monthly candle, it has recovered a little bit. So the total fall from the top has been roughly around 15%. Now, another important point that I will tell you about the India's market is, and this will become evident on a weekly candle. So let me open up the weekly candle, and then the technicals will become a little bit more sensible. So this is Nifty 50 on weekly candle. And let me show it to you in the last fall first. So this was August of 2022. This was the range in which, or this was the pivot point on which the market had consolidated. Consolidated means, let's see, it went up, it went down, it went up, it went down, it broke this channel, then went up, then went down, went up, went down, went up, went down, and then the market gave a rally, right, till here. So this is a very important pivot point, so to say, this particular line, right? Now here, what is happening? Again, the market went up, down, up, down, up, down, right? So the market is somewhat consolidating on this point, right? Or on this line, right? 22,500. This is the level, and now it has started to go up. Maybe it will happen that it will go up, then it will come down, go up, come down. But the breakout will happen from this line. This is a very important point. Natural question comes that, can't the market fall on this line, right? The second line. Well, it can, but how much is the expected loss from current levels, right? So let us take a look at this also. So there is another maximum 9% fall that can happen. See, markets can correct by 9-10% any point in time, but you run a higher risk by missing the gains also. For example, if you are waiting here on this particular line, thinking, you know what, market might correct by like 10% here, or you are waiting here that, okay, the market will correct by 10% here, what you would have missed? There is a very high likelihood that you would have missed this entire rally, which was of 53-54%. So the central message that I'm trying to tell you is that whenever market reaches at a sensible level, some buying should be done. Again, I'm repeating that I'm not fully buying the market. I'm buying the market at sensible level right now. I'm adding more money. Therefore, I'm saying that, and I'm publicly sort of announcing that I'm building a $1 million US portfolio. 25% of it is already done. $250,000 I have invested. where I am at an alpha or I've beaten the market by 5-6% as of now. I'm quite hopeful that I will do well because now I have huge cash reserves in the US, right, which I'm deploying. Every buy and sell call that I'm making, I discuss it with my community members. In case you guys are interested, you can track my entire portfolio. You want to join that community, the link is given in the description comment box. Everything is explained. Every month we have classes. So you can act with a lot of information. You can execute your things with a lot of confidence, right? So, and every month I do portfolio review also. Okay. So I hope that this first point is clear, that whether you look at India market or the US market, the market is somewhat at a sensible buying level. Now, India market, according to me, is at a right buying level. The US market right now is slightly overvalued, but problem in the US market is that you are unlikely to get things cheap. Now, why is that the case? That brings us to the second point of conversation, that you need to understand what is happening in the US market from a macro point of view. Okay. So here, what is happening is that in the US, there is a very clear path of growth. Now, why is growth happening in the US market? Again, I have repeated this statement that if you look at artificial intelligence, machine learning, robotics industry, these industries themselves are growing at a 20+% CAGR. Now, natural question will come, you know what, I've been hearing about these things, AI, ML, this, that stuff for the last 20 years. I don't see like any major application. See, okay, so read about this. So Tesla is building self-driving car. Now that's an application of what? That's an application of LLMs, machine learning, artificial intelligence, and it indicates a commercial viability. Now what ends up happening in these type of innovation when they actually become commercially viable is very simple. That's it. Self-driving cars will get made. They will use somewhat similar technology to do like more intelligent robots. Then they will do like similar technology to do like drone delivery in a more precise manner, in a more non-intrusive manner. So 100 different innovations can be leveraged on each other. Now, why would that happen? And why would that happen in US and China? For that, bear with me. I'll explain it to you in like maybe 2 minutes. The entire tech behind it. Now, if you're from a non-technical background, you would like this explanation. So what is happening right now is that you would have heard of like Grok, you would have heard of Perplexity. So these are like all like what? These are LLMs, right? So LLMs are what? Language learning models. These are basically like, super computing machines in a way. They can process a lot of data from the internet and give some kind of output. Now, LLMs themselves are not very intelligent, right? It's not as if that you will get like a great output from an LLM. Basically, these are training machines, right? These are just very good training supercomputers in a way that gives out output really fast, right? That's the idea, right? But the second stage where we are at right now is these LLMs are connected to tools, or jisko APIs we bolte hain, right? So these are called as APIs. Now, APIs serve a very specific purpose, right? So developers develop an API, or rather they train the LLM to do something very special, right? For example, Perplexity. Now what Perplexity is an LLM, and what it does is that it scans the entire internet, consolidates the data using a particular API that the developer has built to give you a more intelligent output. This is stage 2. This is where we are right now. This was stage 1, stage 2. Now what is happening is that in the last few months, we have progressed from LLMs, right, to tools. So we are adding multiple tools. So tool 1 might be there, tool 2 might be there, tool 3 might be there. Now, how do you do this? So for this, a new language is getting built, right? So which is another layer. So now in the future, what it looks like is that there will be an LLM, there will be a more intelligent layer, which would connect to different tool 1, 2, and 3. Now, this is where commercial applications of artificial intelligence, semiconductor, etc. would gain mass adoption. We are somewhere closer to that. So missing out on US stock investing might not be a very sensible move, which brings us to the story where we started that, hey, why is Mr. Warren Buffett not investing? See, Mr. Warren Buffett has never been a tech investor per se. He has generally been an investor. He has proven to be right. Over the last 30 years, his portfolio used to outperform S&P 500. His return was roughly 21% in the last 30 years, and S&P 500 grew at a CAGR of roughly 11%. Why? Because at that back in the day, like maybe like 40 years odd back when he started his investing career, in that phase, there used to be like companies like Ford Motor, Chevron, all these energy, oil, commodity based, where used to be simple type of businesses. Now things have become much more complicated. Now we live in a world which is extremely volatile. It will go up and down like this. Now, I don't know, where Mr. Warren Buffett would be deploying this $300 billion of cash that he is sitting on. Last time he did it, he primarily did it on Apple. He cut his position, therefore he's on such high amount of cash. But missing out on these type of innovations is something that you can't afford to miss. But Mr. Warren Buffett can still do reasonably well without even touching tech. How he does it? He's magician, right? So let's not go there. But if you are building tech position, then maybe right now is an okay time to at least start building some positions. Third point comes that the macro factors are getting connected together. Now, if you look at the world engine, we have China, right? We have US, and then we can say emerging markets, right? And Russia, we can put it on the side, right? Because it is mostly like trading locally, so to say. It's out of the US dollar system, etc., etc. Now, in the US has tech, commercial tech, lot of innovation happening there. China, a lot of tech innovation is happening there, right? It looks positive, right? So at least from a business development viewpoint, US looks positive. Emerging markets have always it works on ebbs and flow that, these two powerhouses are driving the world economy and the emerging market benefits. So whenever the benefits come to these countries, right, there is a good chance that even emerging markets will start going forward. The key message that I'm trying to tell you is this, that see, back in 2021, 2022, China went through a real estate crisis. Almost 35%, 40% of China's economy used to depend on real estate development. What is happening? The Chinese economy is turning around. They announced that they are going to grow their economy at a rate of 5%. Now, China is roughly a $19 trillion economy. So 5% is what? So it's almost like $1 trillion, which is almost adding 1/3 of India every year. So this is the amount of real value add they are going to bring to the world economy, right? So China is going to be a positive influence, like it or not. US has already announced that it is going to amplify its manufacturing. What type of manufacturing? High end. For example, you would have recently read that Donald Trump had purchased a Tesla. Now, where do you think Tesla is going to focus a lot? It is going to focus in the US. Is Tesla a good stock to buy or bad stock to buy? I'll do a deep dive for my US stock investing community. Now, I'm not saying it's a good stock, bad stock. That's a separate discussion. But what I'm getting at is that even the US will get into high-end manufacturing. Very similar to how China is already doing it. US is also doing it, but a lot of it used to get manufactured outside. By playing around with tariff, it's trying to bring back all this. So if you study the macro landscape right now on a 3-5 year basis, and if you're a 3 to 5 year vision horizon investor, then it's a good time to buy equities even in the US. Now, is this just my viewpoint? No, not at all. If you take a look at this particular chart, what it indicates is that there has been a sudden surge in the buying of equities in the US market. You can see 3 such surges. One recent surge has come now, which indicates that after a 10% fall in S&P 500, NASDAQ, what has started happening is that people have started gravitating more towards US equities. So US is a very precious market right now. People are understanding that and they're diverting a lot of capital there. So yeah, so that's the bottom line, that this engine seems to be okay. We have a very India-centric viewpoint, which is fine. That's not a trouble at all, because all of us have home biasness. But if we just step back and analyze if real productivity in the world can be implemented, the short answer is an absolute yes. It can be implemented. It is on the verge of getting there. The moment such an innovation takes place and it gets regulatory approvals, there is going to be like a massive run up on all these stocks. So therefore, building some positions now, even taking like 5, 10%, 15% hit, it's completely okay. If you miss, then it becomes a problem. Okay. So this is what I would say. Now, what about India specifically? Because India falls on emerging market scale. So here I'll explain you that in the last 3-4 years, what has happened in India is that Indian markets have given run up. It's not as if that Indian markets have not given a run up. But the problem is that if you adjust the returns for US dollars, or if you compare the returns in US dollar basis, then Indian markets have underperformed the US. Why? Because of the fact that INR has depreciated compared to US dollar, or INR has weakened. What is happening in the market right now is, if you study this index, this is called as US dollar currency index. This is a chat that I had with my YouTube member community also, and I had written detailed notes on it. Now let me quickly explain what this means. So basically, this is the US dollar index. It indicates the strength of the US dollar in comparison to 6 top currencies in the world. Now, INR does not fall into this, but there is an indirect relationship between INR and US dollar index, this DXY. Now, typically what happens is that if DXY is strengthening, then INR will fall, typically speaking. Okay. And if DXY is going sideways, that INR will also stay stable. Okay. So these are like two likely, and there is a very good correlation between both these data sets. Now, what you would notice is that it has fallen, right? And the chances are that it will consolidate around this channel for a bit, right? Now, if this happens, what it does is that it stabilizes the INR, which makes what? Which makes the Indian market a little bit more lucrative for foreign investors. Now, if we are smart with our approach and if we try to genuinely attract foreign capital, then giving some tax breaks, all that stuff kind of makes sense, right? Because capital gains for FIIs is not applicable in any country in the world except for that in India. Now, yeah, I mean, such rules should be scrapped so that foreign capital comes, because if foreign capital comes, you will also benefit as an investor in the Indian market, right? So it's beneficial for retail investors because your investments will also go up, right? So this is likely to stabilize, right? So this entire DXY game is going to be more sensible from this point. This is what the data tells us. So there is a good likelihood that Nifty 50 has already bottomed out at this juncture. Now, then comes the next point, that if we study the India market, now in India, what we are trying to do is that we are going to drive consumption, because in the last 2-3 years, there was a lot of money that was spent on expenditure and investments, right? Expenditure by the government and investments by the government. So the entire 2022 budget, 2023 budget, and even 2024 interim budget, because 2024 were election years. Now, these were all very popular budget where the government said that, hey, you know what, we are going to make a lot of investments and we are going to make a lot of expenditures. So railway stocks, defense stocks, all that started running, PSU banks, everything ran, okay? Now, what has started to happen from 2025 is that the shift has come from investment expenditure, that government is not going to expense at the same rate. They have shrunk. Investments, again, no major talk is happening there. The focus is now on consumption. How? In 2025 budget, what has happened? So a tax cut has been instituted for taxpayers, right? Direct tax cuts, which is very good, right? In a way, because it now indicates a very clear focus that consumption will pick up. Now, when would consumption typically pick up, right? It will typically pick up during like festive season, which is the last quarter of the year. So that is when consumption is likely to pick up. So if you are building position in like April, May, June, July, August, then last 4 months is where the actual impact might be seen, because whenever you are investing in the stock market, you have to do a prognosis that what's going to happen 6 months down the line. So in order to be like, benefit from all this kind of up move that might happen here or all that bullishness that might come, you have to build position during this time, right? Right now we are in March. There will be some tax loss harvesting that might happen. So market can just consolidate for the next, let's say 1.5 months. But after that, there is a good chance that, that people will start playing this game, this entire consumption game that I just explained you, because this is where our government's focus is also shifting. So a lot of money might come into consumer stocks. Now, tomorrow I'm going to write like a community note also on consumption driven stocks. I'm already gearing my portfolio towards that. So I'll be adding more positions, right? So I'll explain more, right? What is the meaning of these consumption driven stocks. But having said this, if you're on the right type of stocks right now, there is a very low probability that you will suffer like any crazy losses. For example, if you're picked like HDFC Bank 1.5 years ago, you are beating the market by 20%. Okay, so yeah, people made fun that HDFC is useless, this, that stuff. But HDFC types of stock is what is saving the market right now. Okay, so last 2 points. So next point is that Europe and China are both kind of pushing an agenda called as quantitative easing or increasing liquidity into their market. China has already announced it. And recently, even Europe, countries like Germany, Italy, they have borrowed at a very high rate from the market by offering very high interest on their 10-year bonds. Now, government will only issue a high yielding or high interest rate government bond if they plan on borrowing that money and expensing out or spending out in the economy. So basically, China and Europe are going to do exactly what India had done roughly 2.5, 3 years ago. Okay, that they are going to undertake a lot of government expenditure per se. Okay, which will drive their stock markets also, or that is what the anticipation is. Since the time I had made this video right on China, right, or Chinese investing, I had already invested in Hang Seng. It has been up by 40%. Okay, so I was quite bullish on China, and that bet is turning out to be right. I had increased my position on Hang Seng as well, and I will continue to build more positions there. Now, final point is that if you take a look at mutual fund positions, this is what you would find, that some funds, for example, Parag Parikh and all that, they are sitting on like 20% cash. Now you might be tempted that, if Parag Parikh is sitting on like 20% cash and all this stuff, then I'll also sit on like 20% cash. Okay, now the problem here is that, see, if tomorrow Parag Parikh buys some stocks, and they just, sort of use their entire cash position, buy and stock called as stock X tomorrow, or let's say 5 stocks, A, B, C, D, E, X. Okay. Now, if they are buying these 4, 5 stocks, 6 stocks, whatever it is, then these stocks will suddenly rise. When will you get to know about it? You will know about it in the next quarter filing, or maybe news will come after 3, 4 days or whatever. By that time, those stocks have already run up and you have missed the best gain days. So copying like mutual fund strategy only makes sense if you're getting real-time data. But if you're getting the data after 1 day or after 2 hours, 3 hours, then it does not really help. So if these guys are sitting on cash, the way you need to think as a retail investor is, let's see, boss, they are going to deploy this cash at some stage, maybe like 6 months, maybe like 9 months, 12 months. So therefore you have to invest, right, before they do, and take a little bit of hit on the portfolio if some hit happens along the way. Can a hit happen? Of course, market can fall by 5-10%. No one can guarantee it. It looks like that we have bottomed out. Final point related to this is that if we go back and study why the market fell, it was due to trade war concerns, that Trump has opened up a trade war with Canada, China, that stuff. But this thing has already been factored into the market, right? It's not as if that this is new. It's not as if that he'll open up like new trade wars now. It's already done, right? Whatever Trump announcement had to come on trade wars, this has been fully factored into the markets right now. Now, only good news can come from this point on trade. That's what my understanding is. Good news can come regarding Russia, Ukraine, some kind of resolution. So the markets are going to become more certain. That's how I'm thinking over the next 6 months. And therefore, I have started to deploy a lot of cash that is with me, whatever cash positions I have. In the US market, India, I am almost fully invested, right? Whatever new money I'm making, I'll continue to deploy across both the markets. Now, if you feel that I have done well explaining all these complicated things to you in simple language, do subscribe to the channel and I'll see you soon.